The first ever mutual fund that I bought was an ELSS fund by Mirae Asset. My reason to choose the fund was a very common one. All my friends were investing in it, and every stock market group on WhatsApp that I was a member of was recommending it. I had absolutely no idea who was managing the fund and what the investment philosophy was. And then one day, I was watching an interview of Shri Vijay Kedia ji, and in that interview he was asked how he analyzes businesses and what is the importance of things like ROCE and ROE. Kedia ji said that he does not even look at things like ROCE or ROE. Well, it makes sense because Vijay Kedia ji invests in very small companies, and these small companies burn a lot of cash in their initial phases to grow. Hence, these companies cannot be judged based on ROCE or ROE. Vijay Kedia ji replied that he just looks at the management. He just bets his money on the management of the company. And he has made hundreds of crores of rupees using this technique. For me, this was a moment of truth. After this, I did a little research about the fund manager of Mirae Asset Tax Saver Fund and found out that Mr. Nilesh Surana has been with Mirae for more than 15 years and has generated impressive returns. This was lucky for me. Since then, I never invest in anything without knowing about the management. And the best part is, no knowledge of finance or fundamental analysis is required to understand people, which the management is. All of us have inbuilt skills to understand people. So in this video, we are going to discuss the meaning of management in short, and then we will discuss how to easily check if a management is good or not. The importance of a good management cannot be overstated. So please stay tuned. Namaste and welcome to Retail Investing. Please consider subscribing to this channel because that will help me keep making more videos like this one. So let's start with understanding what exactly the management is. If you search in Google, what is management in business? Google will make you read things like it is the process of planning, organizing, directing, and controlling the activities of a business to achieve its goals and objectives. Saral bhasha mein, in simple language, management simply means this: the day-to-day activities of a company have to be under someone's control and supervision. Even the mighty Avengers had to be put under the supervision of Nick Fury, because without supervision, there will be complete chaos. You might remember that when Nick Fury was out of the scene for a while, the Avengers had a civil war. So all these people who control and supervise the day-to-day activities of a business are collectively called the management. It is the management's job to create value for the company's shareholders. But the management does not own the company. Just like Nick Fury did not own SHIELD, the company is owned by its shareholders, which includes retail investors like you and me who have a minority stake, and then there are the promoters who usually have a majority or controlling stake. Promoter group means those shareholders who were part of the initial founding of the company. The concept of separation of ownership and management is very important in the corporate world. The management team reports to the board of directors who are appointed by shareholders like you and me. For protecting the interest of shareholders, the majority of the board should be made up of independent directors. An independent director is someone who has no personal interest in the company. He is neither an employee of the company, nor does he hold any stake in the company. Since the promoters have a controlling stake in the company, they might influence the management to do things which could benefit the promoters but harm shareholders like you and me. I am talking about things like related party transactions. Another very important thing to watch out for is that the chairman should not be the same person as the CEO or the managing director. It is also important to check that the CEO is not from the promoters group. I hope that the difference between the owners, that is the promoters group, and the management is now clear to you. Now let's have a look at 5 important questions that we investors need to ask about the management. Every investor needs to find out whether the members of the top management have the necessary educational qualifications or not. Are there chartered accountants, MBAs from the IIMs, CFAs, things like that. Although it is desirable to have a management with good education, but fancy degrees do not guarantee competence. Experience makes people competent. So we need to find out How many years of experience does the management have? What kinds of challenges did they face in those years? How did they respond to those challenges? People who have come out successfully from past challenges are likely to succeed through future challenges. Vijay Kediaji looks for management with at least 15 to 20 years of experience. That's because the management would have gone through 2 to 3 down cycles of the market during these 15 to 20 years. That would have made the management resilient by now. Another very important thing to check is that for how long the members of the top management have been associated with the company in question. The longer, the better. The newly appointed CEO and Managing Director of TCS has been associated with TCS for more than 34 years. Another former CEO of TCS was associated with TCS for more than 40 years. Now, this kind of selection process is the reason why I feel like blindly trusting the management of the Tata Group. In every annual report, you will find a part which contains a message from the management. It contains the management's vision for the future of the company. If I were to invest in a company today in 2023, I would download the annual report from 2018 and check what promises the management made 5 years ago, and then check in the 2023 annual report how many of those promises have been fulfilled. This is a foolproof way of evaluating the management. It is mandatory for all companies to follow all the laws and regulations applicable to them. Things like the Companies Act of 2013, SEBI regulations, which keep updating from time to time. If there are any failures or even allegations of failures of complying with these things, it's a major red flag. It's better to run away from such companies. Delegating simply means giving power to your juniors and subordinates. A good management involves people from the junior levels in the decision-making process. There might be a situation in which the members of the top management decide to leave the company for various reasons. They might suddenly decide to retire and enjoy their lives. A competitor company could lure them with lucrative offers. If decision-making is highly concentrated to a few members, the company could get in danger if those few members leave the company. This is called key man risk. Delegating creates leaders of the future, which takes us to the next point. It could take decades for an entrepreneur to create a big successful business, but lack of a succession plan could destroy that business within a few months. Look at Reliance, for example. Shri Dhirubhai Ambani ji spent most of his life to create the powerhouse that Reliance is, but due to not so good succession, half of that business went bankrupt after his demise. The other half thrives under the leadership of Shri Mukesh Ambani ji, and Mukesh Ambani ji has already put a succession plan in place. As we all know, there are only 2 rules of investing. Rule number 1, never lose money, and rule number 2, never forget rule number 1. Now, any investor who wants to successfully implement these 2 golden rules of investing, evaluating the management of the business is of paramount importance, and I think it is the most fun part in analyzing a business. I hope you learned something valuable from this video, and I'll see you in the next one. Have a nice day.